Hi, I'm Peter Linzenbold. As you heard, I come from Experian. I am a former SME banker, and one of these topics I will speak about here is actually SME banking in the digital era. If I look a little bit back, today, exactly this day today, 12 years ago, I actually got my first job as an SME banker. It was taking over for a big Nordic bank, their Central and Eastern European operations, so covering Poland, Baltics, and Russia. And when I was listening to some of the speakers about credit scoring, data, bureaus, infrastructure, trust me, a lot have not changed since then. We are still talking about the same things. Of course, there was a financial crisis coming here, didn't make it easier. There was a debt crisis in Greece, didn't make it easier, and so on, so on, so on. So all the banks have been focusing on getting the basics in place. In the same time, you had, as also Alexander was talking about, the big tech. Forget about fintechs. Fintechs are just there to make some disturbance. It's the big techs that is actually creating the danger. They have been working quite hard, getting a lot of data collected, and then they slowly but steadily are moving into the financial services. And this is where banks have to be careful. Regarding credit bureaus, regulators, so on, they also haven't changed. We are still discussing the same. Can a credit bureau do the scoring? What can they do of profiling? We got the GDPR. Can we actually use the data that we have access to? So to really do SME banking, you actually need to get the regulators on board. You need to get the infrastructure with the credit bureaus on board. You actually have to get the different regulators to speak with each other, data authorities, financial authorities, etc. So with this said, 12 years later, it is actually starting to move in banking, and I will try to come with a couple of examples, both how the customers have changed, but also what the use of data and how that has changed. You'll probably see a lot of overlap from what has been said earlier, especially with Alexander, and it's actually quite interesting to see what's going on in different parts of the world. So this is how the SMEs were looking when I started. Actually, some places it still look like this. You can see the hotel there. They still have my T-shirt. I don't know where it is. They can't find it, so this is why I'm in my nice blue shirt instead of having my name on. But the customers are starting to be more sophisticated, are starting to become more digital, are starting to be more connected, starting to be more global. Even though SME banking or SME customers are solely focusing on the local market in most cases, the suppliers, their production facilities, etc., is everywhere else than locally. Surprisingly enough, this is how credit scoring is still done today in a lot of banks. You have some company files, credit report, maybe some official websites, collateral that might be worth something, might not, and then you make a yes-no decision. The issue with this, that it only tells one side of the story, and it doesn't fit everyone. You still have companies that will not fall into this nice company file, bureau report, collateral, financial data, and so on. So, what is the answer for this? Well, the answer, and we are learning from the big tech companies, we are learning from the Tencent, the Alibabas, and that's really using alternative data. So using data as product information, where the company is located, how it can be reached, if it can be reached, what are people saying about it, and then also on which sites are they mentioned. These are types of indicators that is publicly available and is there to be used, but we rarely see it being used. Banks do not understand this data. Regulators do not understand this data. So how to proceed? Transactional data, we talked about this for many years. The issue is still it's handled quite manually. Connected companies, especially in Central and Eastern Europe, the more east you go, the worse it becomes with group of connected customers. How do you make the credit? How do you make the credit when the owner and the private person is the same person? That it's private money is one pocket, company money is in another pocket. How do you look at the behavioral changes? How do you use this data to actually indicate the changes? How do you get information from other banks? PSD2 is within EU. A lot of banks are still struggling how to use it. Yes, we can do affordability models. Woohoo, fantastic. So, is really all this regulatory work done to only do more automated affordability model? I think not. If you get this right, you can actually make faster and stronger decisions. And not just that, you can actually also improve the customer journey. You can remove the pain of the customers having to walk in with tons of paper, waiting for weeks to get a simple answer of a 5,000 euro credit card. You can remove the pain of having going down to 1, 2, 3 different public places, offices, to collect the documentations. So, you get more actual data. You actually unhide the latest trends. You can predict the turnover. You can actually assess the quality of products and services of the company using the available data on the web. And you can actually look at how satisfied are the customers' customers. Are they likely to come back and buy? Will this company survive? You looked at from the Google reviews, you can look at TripAdvisor for restaurants, hotels, etc. What about startups? No banks like startups. There's no information there. There's no way they can go in. You cannot find 2 years of financial data on this. So, you can actually collect alternative data and then still build a profile of this company and look at the likelihood. Yes, their affordability will still be a challenge, but then you start to grant a smaller loan to start with, and then over time, by monitoring the customer, you actually start to increase the limits automatically. And then there's the existing customers. Banks has a tendency to say, okay, they are in, and we don't care about the customer anymore. If they're lucky, they're part of our early warning system for collections, but in most cases, they're not. But what if there's a change? What if there's change in the behavior of the customer? Nobody's really monitoring that. Should we act? Is it a new sell opportunity? We don't really know. Alternative data can help you with that. I will spend a little bit time on a couple of cases we have done across Europe. First, transactional analysis. This is a tier 1 bank in Europe. They are located in multiple countries. They really had the challenge of credit risk management based on transactional data. We're talking about 2019. Transactional data, internal data, have been available for ages and is still struggling with how to use that. It's automatically collecting data from other banks through open banking. So what we did is we went in, did an analysis. We collected data from different bank branches across Europe. We did the data classification in an automated way. So no more did the advisor have to sit with the 3 months of bank statements and try to make sense out of what are the categories, and then most of the time actually just failing and having as a bulk sum. And then we applied advanced analytics. So the business benefits we saw in using this was actually we increased the predictability of the existing models significantly. We had really a quick return on investment. It's all about money. There's a lot of money to be made using these. We automated identification of more risky transactions like gambling. So we got actually a better profile of the customer. Is this actually an honest customer? And then we optimized the creditworthiness process. Again, 40% increase in the predictability just by using transactional data. That's a lot. Second one, here we used data from open sources. We used web analytics. There was a lot of rejection of good companies, long process for clients with thin files, difficulties with the companies without credit history, as also mentioned before, and more precise analysis of SMEs. We combined with the traditional scorecard. We managed to increase the Gini with 32 percentage point. If you just use the web analytics by itself, you get maybe a 40% or 40 in Gini, which is nothing. You can roll the dice and do a better decision. But if you combine it with the other models you have, you get a strong, powerful tool. 17% of the rejected customers that was rejected earlier could actually get a loan based on this. Decrease in NPLs, 23%. I mean, I used to run NPN portfolios where I had an NPL rate of 25%, 30%, which was not uncommon in Central and Eastern Europe, especially after the crisis. Being able to decrease it significantly, making safer loan, making sure that you can make actually more, you can take up a bit more risky customers upfront. New limits dispersed from these 17% amounted to $51.2 million for this bank alone. So by going in and building a more nuanced picture, you actually are able to get a better view of the customer. You can reduce your reject rates. You can reduce the volumes that you are lending to, at the same time decreasing your risk. So, biggest issue is trust the data, believe in the data, use the data. I still see a lot of bankers who really do not feel comfortable by using scoring and scorecard. But the fact is, you have to do it. You get a better credit profile. At the same time, you save significantly amount of money on the processing side. Remember, if you look at across Europe, you have approximately €300 gross income per customer when you talk about the below €1 million turnover companies, which is around 97% of all customers. you have a cost to income of 67% in a lot of places. By doing this, you can improve your gross income and you can actually lower your cost at the same time. If there's any questions after this, this is my last slide. I did it almost on time. We have a stand out there. Experian is the company. They can tell you a bit more about the different cases and how we're helping companies with this. So, with this said, I'm all done.